Hello, I'm Tom Morrissey from the Morrissey Group, and I'd like to welcome Fred and Diane Baker to your Financial Plan Wealth Outlook. We're going to be doing this on a WebEx. Right in front of me here, I have your financial plan, and I'm going to be pointing to that. You should be able to see it at home. In addition to that, I'd just like to excuse me for this hat because it's either that or this. So we're going to go with the hat. Hopefully, you're a Ranger fan. Um, what we're going to do here is what we put together this plan based on some questions that we asked you. I'm going to go through each section. If you have any questions, I want you to feel free to ask me, even though there's really nobody there. I'm going to pretend you're asking me questions. Anyway, so moving forward, here's what we're going to do. So this is the Baker's financial plan, and the first thing we're going to do is go through a little bit about this report. So I'm going to just read you a little bit that's on page 2, and I'm going to try to go through this quickly here because there's a lot of sections. We're going to go through a summary of your net worth statement, your net worth details, and there's a lot of duplication in that, and it kind of breaks it down further as we go along. So it's cool. And if there's anything you see that needs to be updated or changed, just let me know, and we'll fix it on the spot. Then we're going to go over a wealth outlook allocation framework, a risk categories, risk allocation summary, wealth and risk allocation on your current status. We're going to view your total portfolio. We're going to evaluate the efficiency of the portfolio. We're going to look at some historical risk and return charts. We're going to measure the performance of certain asset classes. We're going to take a look at historical index performance. Some other key factors. We're going to see if you could achieve the lifestyle, and we'll get to that in a second, that you're looking to achieve. And, the results of the potential wealth outlook, the cash flow summary, and at the end of the day, we're going to see if you could achieve what you're looking for. Now, what we're looking to achieve is quite simple. We're looking to make sure that based on the assets that you have now, that you have right now, that you could achieve a comfortable retirement and also leave money for your beneficiary someday. So once again, a comfortable retirement, leaving money to your beneficiary someday. The other part we're trying to look at is whether or not, the allocation that you currently have is appropriate for you, or should some changes be made based, and we're going to go through that. So I'm going to turn to page 3 now, and let's move on. And we're going to go through a summary of some of the findings that we found when we took the notes from you. We found out that you had a combined net worth of $5,625,000. Get used to that number because I'm going to say it like 7 more times at least. Out of that $5,625,000, you have $4,135,000 in investable assets, which represents 73.51% of your portfolio. So, and then you also have, and out of that $4,135,000, 76% of it is equity or stock, 18.14% is fixed income, and about 6% is cash with no alternative investments. This is key because we're going to focus on that later on. You also have $1,050,000 in personal assets, which mainly represent your home and other safe assets, and that's about 18.67% of your portfolio. So that's on your net worth. As far as your assets go, your asset allocation, we took a look at what you have right now, and we're comparing it to what we would recommend for you. When we did that, we had to extrapolate out of what you told us your assets were. And then we had to use what we felt based on the returns and based how you describe the percentages. We were able to figure out how much was fixed, how much was equity, how much was cash in order to make a comparison. The last thing we're going to look at is the retirement analysis, and that's going to show what we all want to know. Will you have enough money to retire? And will these children get some money from you after you're gone, which is what most parents want to do. And I say most because I've had some that just want to spend it all and don't care. And you guys don't seem like that, so you seem like a nice couple. Anyhow, moving on. This next slide on page 4, you have $5,625,000 in net worth, 0 liabilities. We break it down into personal assets, retirement assets, portfolio assets, and other assets, such as a business, and then cash surrender value of life insurance. I'm not going to get into all the percentages because we're going to go further into that right now. Where the personal assets are the primary residence, $600,000, secondary residence, $100,000, investment properties of $350,000. Then we go down to the $4,135,000 in total assets. That's like mutual funds, stocks, bonds, fixed income, cash. We have out of that $2.5 million in retirement assets. That represents the 401k and the SEP account. Then we also have cash and equities, which represent about $1,635,000. Moving on to the next part of your assets and your net worth, you have business interests of $250,000, and then cash surrender value of $190,000 on your life insurance. And the liability screen over there's a big 0 on the bottom, so we have no liabilities for a net worth of, here it is, $5,625,000, which is a great number. The next page, page 6, breaks it down even further in detail, where when you look at the primary assets, the personal assets, $600,000 on the house, Fred's equipment, $250,000, and the personal properties between the two of them, $100,000 each. Then we go further down, retirement assets, Diane's SEP, $1,750,000, which we figured was about 100% in equities. Fred's 401k, which we broke up, $750,000. Total retirement assets, $2.5 million. Personal assets, MFG stock, growth funds, equity funds, global funds, mutual funds, X, muni funds, money market, checking account, basically liquid assets, $1,635,000. Then we have Diane's business, and then we have life insurance cash value, which comes to $195,000. Diane's business was $250,000 for a total net worth of, say it, $5,625,000. There you go. Anyhow, we move on to the next page. Now this kind of breaks into, it's an interesting thing. You have different types of assets. This is kind of a cool chart. I left it in there so you can take a look at it. So when you think about it, on page 8, you have personal assets like your house that, you're not going to sell it. It's going to be there. You can't really lose it. It doesn't, well, I guess it could wash away in a storm or something. But the bottom line is going to be really hard to lose that asset. And we'll get into some other risk factors involved. So that's more personal risk. Market risk is the biggest factor that you guys are affected by. That's stocks, fixed income, equities, alternative investments, which you don't have any, but hopefully we'll be adding some in down the road. Then we have aspirational assets or idiosyncratic risk. That's like, where you want to start a business mainly, or your other high hopes that you want to get into. So when we break it down even further, and we go back a little bit, the personal assets are like your primary residence, cash, furniture in the house, property, cars, insurance, cash value. And what can affect them? Death, outliving the money, interest rates. So those are things that, you really need some sort of catastrophe to affect those things, those items. So they're pretty solid in your family. Then you have market risk. So you have a lot of different types of securities. You mainly have equities, fixed income, and cash. What affects them? Interest rates, market risk, stock market. We can have a virus. Yeah, a virus. And next thing you know, we go from the top of the market, And then we lose 35% of our assets. And we're thinking, why didn't we sell in January? Well, we didn't, I guess somebody could have let us know. And then we could have sold everything and bought back in March over there when we were at the bottom. And we would have been heroes. But nobody knows what's going to happen. That's why we diversify. That's why we diversify to reduce risk and volatility so that we can avoid these big drops and, also get it like an even ride. The last type of risk or asset is the aspirational asset, and that's more like a small business, a real estate investment, or some sort of concentrated stock. Those are aspirational, and those are things that you can get hurt with them, like in a concentrated stock or a real estate investment. But if you can achieve them, that's awesome because you're really making some money. And if we include those in your portfolio here, it brings your total net worth up, if we add in the aspirational risks, to $9,175,000 because of the value of that concentrated stock increased. Went from $600,000 to $3 million. The real estate went up from up to $1.5 million, and your small business ownership increased to $1,250,000. Now, once again, these are all numbers that we got based on you providing it to us, and that's how we came up with these conclusions. On the next page 10, these are a lot of living numbers. So these are items that you gave us, like insurance costs, entertainment costs, food costs, homeowners costs, miscellaneous item, residence costs, transportation, travel, utilities. These items, we try to break it down into that same risk we were talking about before. I don't really think we need to go over that, but this is going to bring you to a situation where you're spending about $5,460 a month, and that's how we came up with the type of risk that you're taking. The total assets and liabilities are once again $5,625,000. Now, I know I'm just going on and on here and not really taking a break, but if you have any questions, now'd be the time to ask. So once again, those are more your expenses, and if we break it down, we're going to have about $890,000 in personal risk, which represents the residence and insurance, and then the market risk is going to be broken down to $4,135,000, which represents equities of $3,140,000, fixed income $750,000, and cash $245,000. And then we have the idiosyncratic risk of $600,000, and that's the small business and some investment real estate. When we look at this now, when we look at your current portfolio versus our target portfolio, there's really a couple of major issues here. First off, and I'm going to round it off, you have 76% in equity. That's a big number for someone your age, and you're really taking a lot of risk or excessive risk for no reason. 18% in fixed income and 6% in cash. When we look at our target model, which is more of a moderate model, we have about 59% in equity, about the same in fixed income, a little about the same in cash, but then you have 0 in alternative investments and hedge strategies or private equity, which we would add in. So we would add in about 15% of real assets. That'd be like gold, gold fund, ETF, whatever. Hedge fund strategies, private equity. We'd add that in. And why would we do that? Because it's a non-correlating asset. What that means, it's not going to correlate with interest rates or the market. It's going to be affected by it. So if the market goes down or interest rates go up, these assets should stay relatively stable, thereby lowering the risk of the portfolio, and in a lot of cases, increasing the return. So when you look at the model here, what we're saying is we want you to lower the equity exposure by 17%, increase the cash by about 1%, fixed income by 1%, increase the cash by about 2%, and then add in real assets, hedge funds, and private equity, which are about total 15% of this portfolio. And all of this is based on our analysis that Merrill Lynch research came up with. So this is not me sitting in my basement reading the Wall Street Journal or some charts like that. This is Merrill Lynch research coming up with a recommendation for you based on how you answer these questions. And how you answer future questions is going to determine how we use our research to help come up with a logical solution for your investments. And we've been using this for all our clients, and we'd like to use it for you. So we go a little further here. The next page 14, and we're getting there. We're more than halfway home here. On page 14, you can see this is a chart that shows risk versus return. So standard deviation is risk. The higher the number, the more the risk. You can see in this chart here, you're the little circle over here on the screen. And like I said before, you'd be looking at this graph along with me, so you're going to be able to see what I'm pointing to. I'm giving you the page numbers now so you know where I'm at. So on page 14, you have the little circle. That's you. That's what your current allocation. Looks like the risk is about a 14 on the standard deviation, which is higher than the S&P. And then we have our target allocation is the diamond, and it has the risk over there, which is probably about 12%. But if you really take a look at the return there, it's around 8%. So you got, a sizable difference in risk there for a little bit of return. So what you have to do is ask yourself, is it worth the risk, additional risk, to get that little extra return? And that's one of the things you're going to have to ask yourself and say to yourself, with the amount of money that I have, do I really want to take this extra risk to get this little bit extra return? We'll continue showing these numbers down the road, but I think that's a very important thing. People that have your type of assets don't need to take that risk and income to get a little bit extra yield. Because keep in mind, if it went down and if the market went down, you not only have to recoup whatever you lost. Let's say you lost 20%. To get back to where you were, you're probably going to make 26%, because now you're making, say you made 20% back, you're making 20% back on a number that's less. So for instance, if you lost 20% on 100,000 and then you made 20% on 80,000, that comes to 96,000. You're still not there yet. So you got to make another 4% to get back up there. So that's probably, like another 6% or so to get to back just to where you were. So that's showing you that that's the downside risk there. We're trying to keep an even keel on this. You don't need to take excessive risk. So we're trying to take the edge off and give you more of a smoother ride by giving you more of a moderate portfolio as opposed to a moderate aggressive. And that's, I'm going to show you two charts on this page. And it's really the risk versus return. In this case, the target allocation is the circle on the top chart. And then you're the square. That's what you have. So you can see there's very little difference in return. And there's a significant amount of difference in risk here. So you're probably, and like I said before, it looks to me like about maybe 15, 17% additional risk that you take for very little extra return. And you can see that when you go to the annualized returns. And once again, we base these numbers off of extrapolating what you had told us. Like we knew what you had, and we knew it was all equity in the SEP, but we didn't know what kind of equity. So we had to, basically take our best guess, and we went with large cap. So when you look at the returns, and I like to look at 3 years, the current allocation is getting 12.57%, which is obviously more than the target allocation of 10.77%. So you'd say, Tom, why would I go with something that makes less? Well, I'll tell you why. Because it has less risk. And keep in mind, it could go the other way, like I said before. So as easily as it gone up, and these charts are showing all up years here on this annualized return. But if you went one more year, like 2020, it's going to show a big down, and the numbers are going to be reversed. So it's going to be, the current target allocation went down less, and the current allocation got hammered. So we're trying to reduce the risk of your portfolio because you don't need to take that risk at this point in your life. So, it's totally up to you if you're gamblers and you want to, but with this money, and based on what you told us in the beginning, we're looking to provide an income for you and leave assets to your children. And in order to do that, you need to be properly allocated. And as we continue on to page 16, you can see, once again, it's going to list the average annual returns here on the chart, and it's going to tell you year by year where you are. What's interesting here, when you look at the volatility on the chart, the summary of results, the S&P 500 has a 12.83% volatility ratio, okay, and the average return of 14%. Your target allocation, the volatility is 8.6%, and the return's about 10%. So as you can see, that's about a 30% difference there in return and risk. So the more risk you take, the better return. But once again, it goes both ways. So you have to ask yourself, do I really want to take on that risk at this point in my life after I built up all these assets? So moving forward, we have a chart here of what's the likelihood of, based on what you own now, what's the likelihood of your assets providing you with the lifestyle that you want? And the answer is right there. You have an 85 to 90% chance of achieving all your goals: clothing, insurance, entertainment, food, home insurance, residence repair, transportation, travel, utilities. You have an 80 to 90% chance with what you have right now of achieving that goal. It also is going to list your income, current income, $350,000 and $100,000, and dividends and interest and Social Security later on in life. So with all these factors taking into effect, you have an 85 to 90% chance of achieving your goals. Let's move on. This little chart here on page 19 is interesting. It's going to give you the diversification of a model that Merrill Lynch picked for you based on your risk profile, and it's a moderate portfolio, and it's going to give you the returns. And so if you went with the moderate portfolio, chances are you have a 95% chance that you're going to make at least 3.659%. You have an 80% chance you're going to make 5.41% chance interest return, and you have a 50% chance of making 7.35% chance, and a 30% chance of making 8.58% chance. And the standard deviation is less than the market. It's 1173 with less risk than the S&P 500. So some interesting numbers here. You have, let's call it the 80% chance is you're going to make at least 5.4% on your money, which is going to give you more than enough money to survive down the road. And here's the other magic number. Based on what we calculated here, on the information that's been available to us, that you told us, you have an 80% likelihood of generating $198,985 a year, which would give you the lifestyle you're looking for. So you got an 80% chance you're going to do that. Later on, I'm going to show you the results of that too. You have a 50% chance you're going to generate $297,000 a year, and a 30% chance of making $370,000 a year. So I think the odds are in your favor. This is kind of a cool chart. It says the same thing. It's going to break it down. It's like a funnel chart. It's going to break it down, and it's going to just show you when Fred retires, Diane retires, and the end days for both of you. And as you can see, there's an 80 to 95% chance that you're not going to outlive the money, that the money that you have is going to be there. And there's even more of a chance that there's going to be a lot more money left for your children someday. And if we keep continuing on and we go to page 24, you can see it starts with Fred at 48 and Diane at 44. But as we go down, at the end of the day, there's an 80% likelihood that when both of you are gone, you're going to have like $5 million from just this money to leave to your children. And there's a 50% chance that you're going to have 24 million plus. And here's a 30% chance, if the market does really well, you're going to have almost $43 million to leave to them. And that's after you took out all that money every year to pay your expenses. This chart here on page 26 continues on with sort of the same scenario, and it's just going to go through the same chart, and you can see the line and the needs being you're above it, you're continuously over it for the most part, and you're not going to outlive the money. When we go further down now, okay, so that was pretty much the summary of the findings from the information. So the next part of this is the appendix, which goes from page 27 to about 45. That's going to discuss all the different definitions that were used, like baseline allocation, asset allocation. There's an explanation here in this glossary. If you have any questions on that, though, that's what we're here for. You can ask us those questions, and we'd be happy to go through that with you. But it's provided in this right here. And as you go forward after that, on page 45, it's going to list the information that you gave us. So here's a couple of things we want to conclude from this. So what we concluded is that you're not going to outlive this money, and you're going to have money for your children, someday. So the worst case scenario, there's an 85 to 90% chance that you're going to be able to pay the bills based on what you have right now, live the lifestyle you want to live right now, and then in addition to that, leave about $5 million for your children someday. So I think that's a wonderful thing. If you can do that for them, you can leave a lasting legacy. One of the other things we looked at, we saw, is that we really need to rework what it's invested in now. And that's what we really specialize in, is investing the money, because we have such superior research, and our investment specialists have been rated #1 in the world. So you really came to the right place. So we need to take a look at what you have now in like the SEP account and the 401ks and your cash models, and we need to say, is this the right allocation, and what could we do to reduce risk and increase return on that money? Because that's really what we're trying to do here, is to reduce risk and give the best return possible. So, in conclusion, with what I'd like to say, what this is all about today, is we'd like to take a look and see if we can come up with some solutions for your asset allocation. You could see that your income and future, inheritance for your children is going to be there. One of the things that this document does is it gives us the ability also to update. So we can update this document anytime we want. So when you take this home, you might want to go through it and say, read through it at night if you need to go to sleep or something like that, and say, hey, this doesn't look right, or I want to tweak this. Why don't we, let's call up Tom or Aaron and see if we could readjust this thing. So we'll go in and we'll make the adjustments, but in effect, if they're minor, fine. If we'll leave it. If not, if they're large, then we'll go over it again. We'll get you in here and review this doc again. The other part is that on the annual review, we're going to ask you updating questions on this particular portfolio to see if anything's changed. In the meantime, if anything does change, like you win the lottery or you get that inheritance from your parents sooner, then we want to include that in the plan. So we would add that in. So this is kind of like a living document. We could change this as time goes on. We can move things around, and things will change because you guys are still young. You know, you got time to work. So a lot of things can happen. So what we're saying is this, is based on our experience, and I've been doing this 35 years, what I would say to you is, why take the risk? You know, steady, be the turtle, don't be the rabbit. Try to be consistent. Try to go, follow consistency and not, try to just run all over the place to make a return. It's kind of where you are now. It's a little haphazard. It needs some sort of plan on the investment strategy. You're going to have to constantly keep changing and updating the estate planning, and that's going to also need to be reviewed by your attorney on a regular basis as well. So I'd like to thank you guys for joining me today on this WebEx, and I appreciate the time that you spent with me. Hopefully it was worthwhile for you, and if I was you, I'd make sure you give me a high grade on this, because I deserve this for 35 years of talking to people about these things, and I should get at least a 95 on this on video thing. I think that would be the right thing to do. So anyway, I'd like to thank you guys for coming today. I enjoyed your class. Really did appreciate it at this age to go through this. And that's it. Take care. Bye.